In the Adani-Hindenburg saga, there is more at stake than the fortunes of one corporate house. The future of India's growth story is also at stake. The fate of Gautam Adani is closely tied to the future of core Indian infrastructure. Here is a brief survey of the Adani projects. Gautam Adani run some of India's biggest ports. Together his 13 ports and terminals handle 300 MMT of India's cargo. They plan to reach a goal of 500 MMT by 2025, emerging as a serious challenger to Chinese port companies. Not just that, Adani is critical to India's ambitions in the maritime trade in the region. Adani is building India's first deep-water port in Kerala to dock mother vessels. This new port will divert substantial traffic away from ports in Sri Lanka, Singapore and Malaysia. As part of India's Neighbourhood First policy, Adani is also building a new port in Sri Lanka. Then Adani recently acquired a port in Israel, countering Chinese domination in the Mediterranean. Adani houses warehouse 30% of India's grain. He also operates a fifth of India's power transmission lines, handles a quarter of its commercial air traffic, and produces a fifth of its cement. In the last financial year, the group's listed companies had total revenues of $25 billion, equivalent to 0.7% of Indian GDP, and a net profit of $1.8 billion. Adani's combined annual capital spending of around $5 billion accounts for 7% of India's 500 biggest non-financial firms. Between 2023 and 2027, his group is forecast to spend more than $50 billion on new investments. Adani is building a new airport near Mumbai, spending $5 billion on 3 seaports, and planning to construct a $5 billion steel mill in partnership with POSCO, a South Korean company. Adani's projects in renewables and hydrogen are seen as the cornerstone of an effort championed by Prime Minister Narendra Modi to turn the country into a global clean energy powerhouse. But all these projects require substantial capital. Some of it was meant to come from the new share offering, the FPO that Adani had floated. The Hindenburg report was designed to choke the flow of funds to Adani and his projects. As a direct outcome of the report, the yields on Adani bonds have gone up, and its share prices have crashed. This would make securing the necessary funds difficult, at least in the short term. Then there are the possible spillovers to the rest of India incorporate. Because of the Hindenburg saga, in just 2 days, Friday, 27th January and Monday, 30th January, global funds pulled a net $1.5 billion from the Indian stock market. For the first time in 2 years, Indian markets were lagging behind other emerging markets. If foreign institutional investors flee Indian capital market, it is going to impact the entire economy. Also, what will happen if Adani fails to complete the crucial infrastructure projects in time? The whole of the Indian economy would suffer. Ports, airports, highways, power plants, and transmission lines are arteries of any economy. All industries and sectors are dependent on this crucial infrastructure. China managed to grow at an unexpected rate in the late 1990s and early 2000s only because it had invested heavily in its infrastructure. Since India does not have the level of state efficiency that China has, it depends on private players like Adani for timely and efficient execution of infra projects. Adani's capabilities in project execution are excellent. Those who are behind the Hindenburg very well know that. Derailing Adani means also derailing the India growth story.